All right, this is the stock market, the S&P 500, and we're going to look at a 30-day cycle and talk about, well, some correction risk that we've been discussing that we thought goes out into the middle of March. And I'll show you how that lines up based on this pattern. So I'm going to leave that gold market right there, and I'm going to move over to the SPX. And we'll move over to the daily pattern. Now, usually I show you the weekly pattern in here, but what I want you to see are the cyclical patterns in here. I know this is a very busy chart. This also happens to have our slim ribbon on there and our slim ribbon PO, which is one of the most amazing signal indicators for momentum you will ever see. Now, I want you to note in here the annotations and the blue lines. The blue lines are showing you the actual lows in cycle rhythms. The distance between this low right over here and this low over here was 33 days. 30 days, 31 days, 29 days, 27 days, 30, 30 right over there. Unbelievable, the rhythms in there. I'm going to tighten this up now for you to be able to get a little better picture of clarity in there. What you're looking at are what we call complex structures of cycles, where we put in the highest expectation, the lowest expectation based on the formation, and also what the average track would be for it to move. When it moves into the top, it's a more bullish condition. When it moves into the bottom, it's a more negative condition. And when cycles form where they make peaks early in the cycle or in the middle, it leaves a lot of time to fall, as you see right over here. When cycles peak very late, well, there's almost no time to fall. And we call these swamped or right-hand translations. This cycle, 30 days, extremely bullish. Momentum conditions, the slim ribbon in here, all of these bullish signals, lots of strength showing in there, and the same thing right in here. It went neutral for a couple days right in here, and then turned bullish again. When this is green, it is bullish. The slim ribbon also, which if you use Thinkorswim, you can upload that, and it also colors the bars for you and colors volume bars. It's all in the coding of that. So let's just look at these last 3 cycles in here. This was a 30-day low right over here, a super bullish cycle. This was affected by the longer-term patterns, which are still moving up on strong momentum. The same thing right over here. You had a decline in here that took you from about 38.73 down to about 36, just under 3,700. So that was about a 170-point move to the downside in this corrective period. It really didn't take very long and held up for a long period of time. Also, there are minor cycles in here. This one only 7 days long. This is 9 days. This is 9 days. And this is totally swamped because you couldn't even get a dip in here. That shows you how strong the upward momentum is. And now the projection of this cycle was up towards these fib extensions right in there. The top of this fib extension was at around 39.25. This one right over here about 39.50. So that's kind of the upside projection to this cycle. This is the intermediate average projection, and then right over here is the lowest one. So we would expect that because the intermediate patterns are weighing on the market, that it is likely going to peak this cycle earlier than before. Again, this was a 30-day low here, a 30-day low here. So the distance from here to here is 30 days. We measure cycle lengths, in this case, in the number of days. The next lows are projected over here, March 8th to March 15th. And you can see these 2 lines over here. This is the principle of variation that says it'll be a few days earlier or a few days later is where that comes. As you saw earlier, there were some 27-day cycles, 28-day cycles. So what the expectation is that because the intermediate pattern is in a corrective period, that this will come down harder. The last time, if I go back in history to the last time we had one of those where the intermediate pattern was negative, was right here. And you could see it fell very, very sharply, and that we have to go back to last March. We haven't really had any intermediate patterns that have been negative since then. So that tells us that we're going to be likely under pressure that's greater than any of these other cycles. That would take us to test the 3,700 area again, which is the bottom of this cycle support right there. That's 36.94. And it could get down over here to 36.25 and under a lot of pressure, 35.35. We don't actually expect that because we've been looking for somewhere around a 6 or 7% drop, which is upgraded from what we thought would be 10% or more earlier. But the stronger the pattern, and you can see the upward momentum in here is still very much in place, then that until it gives up the upward momentum, it's still susceptible to more on the upside. Again, these numbers are right up over here around 39.25 to 39.50 right there. And the likelihood of getting support, if it was a super bullish pattern, would be down right over here at around 38.14. It is really unlikely that a decline from the peak to the bottom of the cycle will be as small as 100 points on the S&P 500. It just is extremely unlikely. It'll be much more likely to be 200 to 300 points on the downside in there, and that is likely to come in the third minor cycle period right over here. So the market could hold up in here, just dance around, pull back a little, try again, and then the real acceleration coming in that final week and a half or 2 weeks, as it often does, as you see right in here. That was 3 weeks right there. This was a few weeks right in here. So the market could chop around in here, but then we think that 30-year cycle joining with the intermediate cycles we've been showing you week after week will push the market down into this 30-day period. That again is what we expect to be a modest correction in the S&P 500 of some 6-7% between the peak that it makes, we think, in the next few days and that period in there of that bottom, somewhere between March 8th and March 15th would be our guess, which would take you somewhere around that 30-day period from that last low. Again, we're looking at this low right over here plus about 30 days, which takes you out over here, just as it did right over here, and it did actually right over there also. That is a look at the short term and intermediate term, really, as we're looking out into March for the stock market. I hope you found that unbelievably valuable. We always want to bring you the best information we could possibly bring. We can't be successful unless you are, and that's all we care about is your success. So please, if you're watching this on YouTube, give us a thumbs up. Hopefully you give us a nice comment on the information that we bring to you. Some people are not polite, and we take care of them pretty quickly. So we love to get your comments and love to get anything you have that is good feedback to what we do and how we can always be better. We don't like impolite people. That's just the issue.